Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after noon on November 29th, and we are back with Vince Lanci and Tom McEntee. They've been talking about equity strategies, option strategies, going through delta, gamma, theta, looking for risk-reward opportunities, showing you the way that they've been doing it. Both Vince and Tom have over 30 years experience trading future equities and options, so you got some great experience here. How's it going, Tom?
Very good, Michael. Thanks. It's good to be back, and it's good to have Vince off the. Vince pulled a Willis Reed today.
Off the schneid? Yeah, Willis Reed.
He's coming down the tunnel right now.
I'm never going to get a flu shot again because it gives you the flu, and then of course, Nyquil and Scotch don't mix very well together when you have the flu.
That's a nice combination.
Okay.
So, guys, you want to just keep going with? We'll just drill down on those three Greeks we've been speaking about. So, hopefully, people have a firmer foundation. What do you think, fellas?
I think, yeah, and we can add to it if we have the time. We can add to it depending on what people in the audience want to hear. But yeah, I would love to go over at least those three Greeks. Sure.
Okay, let's go back to where it all began. In the beginning, there was the alpha, and now we're going to call this the delta. You like the way I'm riffing? Okay, this is delta,
Yes.
right? As we know, is that's an equivalent ESP equivalent to stock position. So Apple is where 178. These are 1 month options. Deck 21. That's what's highlighted here. Okay, December 21. So yeah, what's that? 3 weeks, I guess. The 170, the 170 set of the at the money calls are about a 54 delta because it's slightly in the money. Okay, so that's with roughly a 3 gamma. And everyone knows what gamma is. Gamma is rate of change of delta. So up a buck, say the stock trading 179, these would carry a 57 delta. If the stock trades down a 177, these would be about a 51 delta. Now, when Vince and I first started talking, on our first class on Tuesday, the 27th, I think we were trading somewhere around I remember if we were on the line, the stock was somewhere around here, 173-ish, I guess. That was right about when CNBC, when three guys on CNBC, they put them in a box, and Apple was trading 170.90. And all 3 guys said no, no, no. And one guy said 169.20, maybe. So all the bulls had turned to bears. And we were looking at this. No, we were looking. I'm just telling you how quickly these things move. If I'm not mistaken, Vince and Mike, check me on this. I will make mistakes. The 172s were kind of at the money then, if I'm not mistaken. Is that true? And probably trading around. I think the strata was 560, 570, give or take.
We were still in that gap lower area.
I think. So I think we're right around 73 in the stock, give it ballpark. And the strata was like I'm going to say 550 to 560. I'm almost positive. Okay. So now, obviously, things change dramatically because look, and obviously nobody waits. No one gets hit over the head and wakes up in a coma, and all of a sudden the stock presses that old gap. That there's a gap out there, fellas, and you got to be aware of it. 181.5 to 185. Like a moth to a flame, things go there, and they usually get filled. So it pushed through there a little bit today, penetrated. I guess it got to 182.70, and then retreated. But whatever. This is what Vince and I want to talk about. Now.
No, we want to talk about voodoo magic technical analysis. No, I'm just kidding.
Yeah. So anyway, if you bought these at $2, say you bought them at $3, they were a little bit cheaper. We'll keep it simple though. You bought them at $3, stocks, and you did nothing. And obviously that doesn't happen. But I'm just saying, in a perfect world, you did nothing. Stocks trading 81 yesterday in the bell, and that's when you could have sold it, right? That's probably when it was tough to sell. Obviously, stocks trading 81. I mean, you could have been a freaking seller up there. Locking in, essentially selling the synthetic call. If you're thinking about it, if you're selling a stock at 181, you own these calls at $3, we'll say for argument's sake, from Tuesday. Not a bad return on, you can sell the stock at 181. Now think of what's happened here. Now, perfect world. I get it. Don't call me out on it. I know the game. I'd have been selling at 176. So I'll full disclosure.
No, we're only moving one. When we change scenarios for people to learn, we're only going to move one parameter at a time. So you're not changing volatility. You're just moving the market, and you're saying, what you could or could not have done.
Yeah,
the choices that options give you. The flexibility is what you're getting at.
Yeah, and Vince and Mike and I speak about this quite frequently. The utility of gamma, that's what's embedded in all, that's what optionality is about. The utility of gamma, how you use it. Like we said many times, I'm not looking to buy something at $2 and sell it at $3. That's not the way I play the game. I'm just looking at it's a tool or it's a means to an end. And however I can spread it, however I can express it, be it directionally, I want to do it. So anyway, long story short, hey, if I sell stock at 181 yesterday on the bell, 3 o'clock, between 3:30 or so, whenever it pressed there. Well, now I own the 170. Now I have a free game in here, right? I've already sold my calls out synthetically at $8.50. Synthetic, with the put still worth something. I'm sorry. What am I looking at? I'm looking at the wrong freaking strike. I want to look at Deco 7s. My bad. Hold on 1 second.
Hold on. While you're doing that, I want to say something because I want people to write this down so they can follow you when you start riffing on this. Yeah. While you're because this what you're about to do with this whole synthetic call thing and is really important. And I want to give everyone a formula that you actually talked about the first day, but I want to give it to them in just a simple math formula to write down.
Go right ahead.
Everybody, please write this down if you want to follow along with the synthetic call, synthetic put, and flexibility formula. Call minus put equals stock or futures minus strike. And that is the formula. Call minus put equals, we'll say for today, we're saying Apple. Call minus put equals Apple's price minus strike price. And that is the call put parity formula. So when Tom says you synthetically sold the call or you synthetically sold the put, if you look at that formula and you know 3 of those things, you can find the 4th. So if the call is worth 10 and the put is worth 5 and the stock is trading 175, and then you know the call is in the money by $5. So that means the strike must be 170. And that formula is something that you have to memorize if you're a volatility or options trader and you don't have a screen in front of you. But that's what Tom is about to, I think, delve into, that you buy the call at X price when it's out of the money and you're buying all extrinsic or time value, and then it goes in the money, and then you sell. I'm not sure how he's going to do it, but when you get there, Tom's got choices. When he's got profits, he could either sell the call, he could sell stock, or he could sell the put and or buy the put. I don't know. It depends. There's a lot of things he can do, but just have that in front of you. Call minus put equals futures minus strike or stock minus strike. And that formula gives you the call put parity formula that allows you to say things like synthetically selling the call, synthetically selling the put. All right. I just want to get that out there before you started doing your thing, Tom. Thanks.
No, that's an excellent point, Ben. 27. Hold on just 1 second. Okay. Excuse me.
Wait. I want to say one more thing. It's the same exact thing in even simpler terms. If you don't want to think about math, I want you to think about it this way. A call and a put are the same thing if their delta is hedged. Meaning, once you buy a call with a 50 delta, let's say you buy 100 calls that have a 50 delta, that means you have, as Tom and I discussed before, you have 50% exposure to a move in the stock. And then you sell 50 shares of stock. You have for that moment, we're not going to get into gamma for this, you have no directional exposure to the market. But you do have volatility exposure. Now, we're not talking about volatility, but what you have now is if you take a call and you hedge the delta, it's the same thing as taking a put and hedging the delta. Now, when you look at it that way, what really is going on here is that a call or a put or any option, they're the same thing. So any difference in price between the call and the put, if the one with the bigger value is in the money, the one with the smaller value is out of the money. And if you want to know how much time value is in the option versus in the money value, when that call that Tom bought 2 days ago, he's going to hedge or however he hedges it. If you want to see how much money you've made, all you have to do is subtract. You have to subtract money if you're looking at the moneyness of it. But you can look at the opposite, the same strike put, and you can see the difference in the money versus out of the money. So a call and a put are the same thing if you hedge their deltas to flat. And that said, sorry, Tom, go ahead.
That's all right. No, you're fine. That's look, I start to go off on tangents like we discussed.
No, but I want to get that in so you can go off.
Yeah,
I don't want to interrupt you when you're on a roll.
No. Pump the brakes, no doubt about it. Okay, so what Vince is saying, and he's 100% correct. That's how you have to look at things. I mean, this is a put call parity is a fundamental of option arbitrage. The ability to create synthetic long stock or synthetic short stock, that's what determines pricing. So we bought this. I went back and looked while Vince was talking here. I'm not sure. I mean, I'm seeing that this straddle 172.5 line closed Tuesday. We spoke about it Tuesday around this time, so we lost 3 hours of time there. But I think it closed Tuesday at like I'm seeing about $4.75. Okay, now it's only worth about $6. But now think about this: was it worth when you could have paid? I thought you could have paid $5.50. I could be off. Could have been cheaper. I'm not quite sure.
Make up a number. It doesn't matter. Give them a number to write down because they're going to do math while you're giving them numbers.
Yeah. Okay. So say you could have bought this straddle at $5. We'll say it was $5.25. You could have bought this straddle at $5.25.
Wait, we're not buying a call. We're buying a straddle now.
We're going to buy a call. We'll pay $2.70 for this call.
Okay. Good.
Stock was trading 173. Okay. I'm almost positive. Okay. Now, hey, nothing happens, and all of a sudden yesterday it's 181, and people are running for it.
Okay. Hold on. You bought the at the money option, correct?
Yes.
Okay, so Tom bought the at the money option on Apple, and we're going to say it had a 50 delta. And now
I bought 10 of these. It's like 500 shares of stock.
Okay, so there you go.
Well, I bought 10 of them. I paid $2.75.
There you go.
This is where you're getting that multiple of X type of return here. I go out and buy 500 shares of Apple at $172, and I'm lucky enough to wait and sell it at $181. Well, I made $8.50. Right, that's about roughly 5%, which is a great return. And obviously, in 2 days, I'm a fabulous day. Sign me up for the next 3. But if I pay $2.70 and I can sell the stock at 181, synthetically selling the call at 8.5, synthetically selling the call because I'm selling stock at 181 against the 172.5.
Okay, how many options are you long?
I'm long 10.
Okay, and because stocks are round lots, 10 options represents how many shares of stock?
I would say at that point in time, I would say
no, forget about the delta up there. I'm saying 10 options.
Oh, yes. I'm sorry. Yeah, 10 options will be 1,000 shares of stock.
Right. Okay. So one option is 100 shares of stock. That's how people look at it. There's a multiple factor, and that's for the commodity guys, Tom, who don't get that. So now you have the ability when it's in the money to sell, and we're not talking about deltas for this moment. I think you can sell because you bought 10 options and the market has rallied and you're in the money, and you can sell 1,000 shares of stock because you're
correct. Absolutely.
Okay, so what does that mean? What have you done? What does that mean? And what does that allow you to do if the market moves again?
Yeah, sure. Okay, now I got $8.50. Okay, now I said, boom. I'd rather sell the $181 stock than the $8 call, than the $8.50 call. I want to see maybe the stock comes in. Worst case scenario. The stock goes to 612 tomorrow afternoon. You synthetically sold those at 8.5. You paid $2.75. You made $5.75. That's a great return.
Right. So the market goes up, and Tom's not looking at deltas at all. He's just basically saying, I have exposure if they were to go in the money and expire in the money to 1,000 shares of stock. Whatever the delta was, maybe it was 60. We're going to say he wants to sell the calls, and he wants to get out of all of his exposure and lock it in. He may not be bearish, he may not be bullish, but he just doesn't want to worry about it anymore. So he sells all of his stock that correlates with all his potential stock that correlates with the option. And he's not trading volatility. And if the market goes up, his profits are capped. But if the market goes down, he can make money.
Right, exactly. The key phrase there, Vince, was my profits are capped. That's correct.
But they're also locked in, exclusive of the time value that you'll get to, I'm sure.
Yes. Worst case. The worst case I'm going to do is make $8.50. The difference between where I sold the stock, 181, and the strike price I'm long. I'm long the 172.5. 181 minus 172.5 is 8.5. I pay $2.75. So the worst case scenario is I make 8.5 minus 275 is 575. But now I'm short the stock and I'm long these calls. Okay. That makes me long these puts at a song. It probably, what did I do? I sold it for about a $5 credit, right? So I'm long these here about a $5.75.
Okay, that's good. That's good. Anyone who's listening, who's focused on this, take all those prices down and put them down. The call value when he bought it was 270. We'll call it.
Yeah, that's fine.
The call value, and then and then you write the strike in the strike put. What was the strike you bought? Let's just say
I bought the 72 halves.
Okay, so it's 172 spot 50 strike. Okay, and now the market is trading where? Where'd you launch your stock?
I sold stock at 181 even.
Okay, so 181 even is your stock, and that should give you the price of when you fill in the price of the put, you're going to get a difference, and that difference is going to be the profits that Tom's locked in.
Right. So now I own that put for a credit. But what this gives me is this: is that okay? Say I sell 1,000. All right, now I own that 172.5 put. Probably not going to amount to anything, but I own it for a $5.75 credit. Okay, so now they see. Now if you're following along at home, I get that by adding what I paid for. What I paid for the call, which is 270. I add that to the strike, 172.5 is 175.20. I sold that at 181 even. Get it? Strike price plus call debit paid. 72.5 plus 270 equals 175 spot 20. Where did I sell the stock? 181. That makes me synthetically long the 172.5 put at a $5.80 credit. Okay, you follow that? That's 181 where I sold the stock minus my total, my net debit of the strike price plus cost. So that is the put call arbitrage. Well, now I own that thing for a 580 credit. Well, that puts trading at 18 cents. It's probably going to be a rip-up, but, and maybe I'm getting too far afield here, but that's okay. But I think you can handle it. Hey, now you come in this morning and the stock's trading down at 78. Maybe you like the stock. I don't know. But you could take back a portion of it. You could take back a portion of it and still play the game if you wanted to. Worst, like I said, you own this put for plus 570. If you wanted to, you could take back, say, half. Take back 300 shares, for argument's sake. At once, right here, 178.13. I think the stock's going to rally. I think McEntee's right. It's going to fill the gap at 185. Let me buy 300. I already locked it. I already got a profit on the other 7. I'll make 3 points on 300 shares, and we'll see what happens. Now we got a game. Now it may not, you may not get a P out of this whole freaking thing. You're going to lock in a certain amount of profit, but you still have a game depending on how you want to play. This is the utility of gamma. Like, I'm not a big advocate.
Hold on, slow down. Gabe's asking a question. I want to make sure he catches up.
Where are you, Gabe? Where are you?
Put at 181 and call it 172.5. No. The call. All right, your formula, Gabe, should be this. Tom's doing it right now. Tom's going to type the answers into you.
Just keep talking, man. I can't do. Okay. I can't do both.
Okay. Basically, what Tom's saying is he's buying the call, and he's naked long the call, and we're not looking at deltas here. And that call allows him to control 1,000 shares of stock if he were to exercise it in the money, or if he were foolish enough to exercise it out of the money. So he wants no more exposure to the stock going higher after the option goes in the money. So he sells the full 1,000 shares. He's not delta flat. He's not delta flat. He's stock flat, which is a little bit different. And then at that point, he can't make any money going higher. But what he has done is he leaves himself exposed to being long. He makes money now if the market goes back down. So he would be trading if you buy 10 options, which controls 1,000 shares of stock, and then you sell 1,000 shares of stock instantaneously, you have synthetically created a long put position. So what Tom is saying is he bought the call at X price, and then the market goes up, and then he looks at the intrinsic value of that call now and subtracts it, and it is equal to the value of the out of the money put. And so he looks at the profit that he's made, which is $5.80, and the put was worth whatever it was worth, but now he owns the put for a credit of $5.80. So he has a lot of choices he can do with that now. We'll come up with simpler examples as well, but that's what happens.
Now, I put a question in the chat. Gabe, John Hassinger, Mike Strong, and Sunil. This is what I'm talking about. It's not going to happen. I get it, but you never know. What happened to the stock trades down at 165 tomorrow? You don't know. Now think about that. What happens now? Now I'm on that put for 5. What's that put worth with the stock at 165? What's the 172.5? I'm asking a question, Vince, to these people, to the people out there. Maybe they.
I don't know the answer. I don't have my HP12C in front of me.
So what's that put? You want to ask yourself, what is that put worth? What's the 172.5 put worth with the stock trading at 165?
So you would then take the 172.5 put, guys. Look at that formula, right? You don't even need to know the formula now. The 172.5 put is in the money or out of the money. It's in the money.
With the stock at 165, it is in the money, yeah.
Right. So then you would subtract the price of the stock that it's currently trading at from the strike, and you would get how much money it is in the money. Not necessarily the price of the option, but you will get at least its intrinsic value. Yeah, Sunil's got it, $750.
We got it, right. So now what's happened, Sunil? What did I make on it? Now this is like a freaking, this is like the Macmillan textbook I read. All the examples were winners. What did I make on the trade? Now I buy the stock back at 165. I'm out.
That's an advanced question. You should go through that step by step how you made what you made.
Okay. I'll keep talking. I'll type.
Okay. I think we're also going to do. I want to do this. We're going to end the show on a horror show. I want to give you guys an example of how options can be used by market players to hide their real intention. I'm going to describe how Philip Brothers bought calls to make Philip Brothers used to buy calls in oil when they wanted the market to go up, and then they would sell futures 1-to-1 in the market and convert them into puts. And everyone was getting bullish watching Philip Brothers buy a call or Fibro, and then the market would just crash after that. But I'll give you that story in a second how it worked. But let's stay with the math.
So I think Sunil got it right away. That's it. That's the utility of gamma. So that's why I would advocate everybody out there, if you were fortunate enough to do something like that in Apple, in the spiders, anything that had an outsized gain yesterday, and you had a free runner on something like that, I would never, and I'm not a big fan of the word never, the words never and always.
Never trust someone who always uses superlatives. There you go.
I would never sell the option. I sell the stock because now I got to look. Follow me? Now I get a free look. This game is about looks, and the cheaper looks I can take, the more I want to take them. So when you get something like that, I would always advocate. What, for a couple of freaking pennies? Well, that would have been another 20. You probably would have gotten $8.07, about $8.90 up there. Big deal. Who cares? I'd rather be sure at the $181 stock, and we'll see what happens. Now it's game on for the next 2 days. I don't know, but I could trade the stock, and I'd like to think I'm fairly adept enough in doing that I can make that 40 cents up. But that's one way. That's the utility of gamma. We're using delta. Now look at how much the delta changed. At 172.5, we said this was like a 40. At that point in time, stock trading 73. Stock was about a 52, 53 delta, right? The stock jumped, $8, $9 up there at 180, and time goes by, blah, blah, blah. Up there at 181, that's a 90 delta. Okay, then that changed dramatically. That's the rate of change of delta. Now, I couldn't have sold 1,000 shares of stock at 172.5. Now, yeah, that's a good thing.
Check what
if I just sold the stock at 172.5 against the calls I bought at 270?
Check what Sunil wrote in the chat. Check what Sunil wrote in the chat.
What's the premium? Total gain of 13. He's right on the money. Spot on.
Okay. So now, so we'll let him boil it down for us, and then you can just go off on the.
You know what I'm going to tell? I'm going to type another question to the chat, Vin, and then you keep talking. All right? What?
Okay. All right. So you can use options to play interest rates by something called boxes. We'll talk about those. Conversions, reversals, Those are ways to be synthetically long or short stock or futures. Boxes are things that people used to borrow or lend money, and that's a big business. Something that we used to do in gold for arbitrage. If you're a company that wants the market to go up, but you don't want to buy shares and you want the market to go up, you can telegraph it by buying options very sloppily. That would be called spoofing, and I'll give you an example of that in oil when we have time. But you got your question out there? Yes.
Yeah.
Okay.
Now this is probably a more real life example, but okay.
XDM has it.
Boom, he's got it. That's good, XDM. Well done.
Yeah, he's an option guy, no doubt about that.
Okay. Well done, 270, 173 and a half. What does he give me? A 23-cent gain? But more, better than that, right? I paid. He made 80 cents, right?
Let me see.
Should have made 80 cents, right? 270.
No, I'm not even paying attention
three and
anymore.
a half.
It's a stock. I can't do math on stock.
Gabe B. What does Gabe B say? -3.5 plus 8 plus 5.8. Well, okay.
How would I have done if I'd sold stock at 176 instead of at
Yeah. That's right.
instead of
That's right.
Right.
I should have. That's right. Okay. Very good. There you go. So that's more. So we're going to make 80. That's an 80 center, right? 270 at 520. It's an 80 center. So now I'm long that synthetic put at 80 cents. So I'm a loser, right? I took it 80 cents. Okay. Yes. Okay. Let's see what he's got. Well, I can see this. I think this is the way to go, man. Let these guys interact.
yeah.
See if they're getting it. They're following along.
Yeah. So we're actually out there and letting them Tom to me. We're just kind of interacting that way, and I'm just filling space with commercials about how options almost blew me out. So while you guys are doing that, and we'll review this. In the mid 90s, when Philip Brothers was at their peak in oil, they controlled a lot of refineries. And if there was a refinery fire, they knew about it before anyone else. And whenever there was a refinery fire, they let the world know that the market was going to go up. And I'll tell you how they did that in a second.
Yeah. So guys, you're out there. We'll just keep it moving. I think you're on the right track. Okay. I paid 270. There you go. Boom. There. Okay. Plus 80 cents. Plus 80
Right.
cents. Very good.
Right.
Gabe, well done, Gabe. You're out there. I'm assuming you're listing plus 80 cents. I own the thing. I still own the thing for a credit, for an 80-cent credit, which is great. Worst case scenario, I'm locked in. I locked in 80 cents and I still have a gain. Okay. That's probably more real world. But I still have it. And that's important to realize. So that as we move up and down, look, things change here. The stock was 172 on Tuesday afternoon. Traded 182 this morning. Things change and it's fluid. It's best to avail yourself of the deltas and all these things and how they relate to each other. I would for an exercise for the next 3 hours left here. Watch this thing. Well, I would watch these three strikes. Watch this fly. Watch this butterfly. This fly around 77 and a half. Because you're going to see. Now, what's going to happen? We got one day. This is a good exercise, actually, right? But, I mean, where is this? Tomorrow.
Yeah.
Tomorrow, where are these 175 calls stock here? Okay. If the stock closes 178 spot 40, 178 spot 40, where are the 175 calls?
You would have to back out the overnight theta or erosion.
Well,
no, I'm just doing that so they can think about that. You want to highlight that for them?
Right. So what's the extrinsic at expiration? What is the extrinsic value of the 175 call with the stock trading 178 spot 44. Whatever.
Right. Well, the extrinsic value at I'm going to answer that question. The extrinsic value at expiration on a money call would be the same extrinsic value as the out of the money put that goes out worthless, right?
Correcto.
Okay.
I meant to say intrinsic value.
No, I know. That's why I went with it that way. So the intrinsic value of an in the money call that expires in the money, to be redundant, would be the difference between the it's in the moneyness and the stock price. So the strike price and the stock price would be its value. Correct?
That is correct.
Okay.
That is correct. So tomorrow, stock here, 78.60, we'll call it. These calls are worth $3.60. Okay. Now the difference between where they're trading is coincidentally the price of the put. The intrinsic value of these things is like $3.68, $3.60, right? 178.60 stock price minus strike price. Stock price minus strike price. Stock price, strike price. Okay? 78.60 minus 75 is 3.60. Intrinsically, they're worth $3.60. Why are they trading at 4? Well, the put's worth 40 cents. The put carries the out of the money option will carry the extrinsic value of the straddle, whatever you want to look at, the extrinsic value of its corollary over here. So I would watch this. Keep an eye on the fly for the next 2 hours. Watch how this fly behaves. 75, 77, 80. Now I could buy this thing right now.
We're not doing flies right now, right?
No,
are we doing flies now? Because we can do flies, but I want to do a real life example of put call parity involving the Philip Brothers thing. That's why I started.
Go ahead.
Okay. If anybody's interested, I'll give you a real life example of how the put call parity worked with Philip Brothers, myself trading as a market maker in oil, and a refinery fire. So someone type yes if you're interested. Otherwise, we're going to talk butterflies. It's a good story. Did you just type yes?
Yes.
Still messed up. Okay. All right. Here's how it goes. For months, trading oil, Philip Brothers used one broker, and the broker's name was Brett, and his badge was VRAN, which I'm just giving you a color to paint the picture. So I learned that whenever VRAN bought calls, the market went up immediately. So as a market maker, I wasn't directionally interested. So if VRAN bought a 50 delta call from me, and we're not going to get into how I made my money, all right? We're just going to say that I didn't care where the market went. I just wanted to make sure I hedged my delta risk. So I didn't care which way the market went. I wanted it to go fast or slow depending on my position. So here's what happened for months, and here's how I got hosed. So VRAN comes in, and I didn't know who his customer was, and he would come in and he would say, "Give me the price. I'll make futures prices up for you to make it real. But let's say oil's trading at $40, and he would come in and ask for a market in the $40 call, and I would make it for him, and he would buy it. And before I even got my hedge off, because I had to buy futures, so I would sell him 100 $40 calls that had a 50 delta. I had to buy 50 futures, but before I could even get my 50 futures off, the market would rally 25 cents. And every time he did this, I used to get hosed. So I got smart. When he started quoting calls next time, I would start buying my futures before he traded with me. And because his customer was always right. And I never understood why. And I didn't know who Philip Brothers was at the time. So as he would ask for the at the money 50 delta call, and I knew I was selling between 200 and 1,000, depending on how much vig there was in the market. But let's just say I sold him 100, and people wouldn't quote him, they wouldn't make markets for him, and I was the only one doing it because I was the naive guy. And but I got smart, and I made him a market, and he lifted me. But before he lifted me, I didn't buy 50 futures. I bought 55 futures because I knew he'd be right, and I would have 5 extra futures that I could sell up higher. Because I was basically front running his smart customer. So VRAN comes in and he goes, buy him. I sell 100. But before I sell 100, I already have my order to buy 55 futures in. I get a good fill. The market runs up and I sell my 5 extra futures out, and I'm making money because his customer is so smart, and I'm using that information flow to trade. I'm flow trading as a market maker. And then I learned that, of course, I had to find out why he was right all the time. And the customer was Philip Brothers. And I'll tell you how I get hosed in a second. So Philip Brothers, they controlled refineries. And if there was a refinery fire, they knew about it. So they would buy calls, not because they didn't want to buy futures. They were buying futures too, but they had an options trader on one desk and a futures trader on the other desk. So this is like a merchant energy bank before they actually were created. So the options guy would be buying calls as the futures guy was buying futures. So the options guy would get his calls in first. The market would always run up, and then the headline 5 seconds later would be refinery fire, refinery shut down for 2 hours, and the market would run up 20, 30, 40, 50, maybe $1. And so this would happen on occasion, and I would make money, and they would make money, and I'd be happy. This is on top of the actual role I had as being a market maker. And then one day, this is how I learned how put call parity. I mean, I understood it as an options guy, how put call parity works directionally, which is what Tom is describing if you're a directional player. So one day, VRAN comes in and says, where are you on we'll say the market's $40. The market's trading $40 exactly. Where are you on the 40 calls? And I made him a mark. I'll say 70 bid at 80. And he'd go buy, and I'm like, here we go again. I'm going to make easy money, right? So it's a 50 delta option. I buy 55 futures, but the market doesn't run up 30 cents this time. It stays right there. And I get a great fill. And I turn to my boss and I go, his name was Blake, and I go, check out the fill I got. I got a great fill on my futures, and I sold calls to Philip Brothers. We're going up. So it was a 50 delta option. I bought 55 futures. So I'm net long 5 futures. Okay, so I'm long the market, and I'm expecting the market to go up. Well, 5 seconds later, the market drops $1, and I'm green, meaning I'm new, and I'm also green in the face, basically vomiting in the pit because I was new, and then I'm looking. I saw my 5 futures out, and I lock in my losses, and I go, wait a minute. Philip Brothers buys calls, market goes up, I make money because I buy too many futures. But this time, Philip Brothers buys calls, and I get a great fill in my futures, and market goes down. What happened? And then Brett comes back in, and he goes, how are you? And this is the 40 strike we're talking about. He goes, how are you on the 40 put? And I go, Philip Brothers never trades puts. What the hell is that all about? Well, I make a market high. I fade him as a buyer because that's all Philip Brothers ever did. They would buy options. They were long options players. And he just slams me. And he hits my bid. And I have to rush in, and I have to, because I bought a put, I'm now short the market. I thought he was going to buy it, so I made him a high market. I honored my market. I bought the put, right? I still don't know what's going on, but the autopsy will reveal what happened. So I buy the put from him, from this broker, and then I have to buy futures, and of course the futures run up, and I get killed. And I think about it, and I go, what happened there? And I go up to the VRAN, who never disclosed who his customer was, but we had a good relationship because I was a very reliable market maker for him. I would get things started, and he would give me preferential treatment because I was reliable. It was a contract. People wouldn't make markets. They'd hide their heads in their sheets or their computers, but I would always make a market. And he said, well, Vince, you know how they like to buy calls when the market's going up, and then make money by selling futures up higher? I didn't know they sold futures up higher. Is that true? He goes, yeah. Well, this time when they were buying those calls from me really hard and really sloppy, and you thought you were making all that money, they were selling a future per call they bought. And I'm like, so what does that mean? Who does that? I don't do stuff like that. That's a synthetic put. Why would someone? He goes, remember how 15 minutes ago I just sold you puts $1 lower at a higher price? I go, yeah. He goes, well, they bought the put synthetically from you. They were getting short that time. They came in backwards. So they said, buy the calls, Vince. We want you to think we're bullish. And they were just selling futures like an MFer in the market. And that's why I got such a good fill. And then the market dropped, and they said, hey, Vince, we're going to buy puts now. How are you on the puts? Oh, well, you're buyers of options. So I made a market for them to buy puts, and they sold them to me. So now their position is long the call, short the put, and they sold futures higher. So they basically got me to buy more futures than I had to, number one. Number two, they got the market to rally on sloppy buying, and then they sold more futures than they wanted to. They created their own exit strategy. And then after the market came off, they said, we're long the put synthetically because for the 1,000 options that we bought, we sold 1,000 futures. And so they made money on a synthetic put by buying a call and selling a future 1-to-1. And when the market went down, they then sold the put back to me. It's like they just took the ATM card out of my pocket and just went to the machine and took cash. So that's basically how a synthetic can be used to run you in. And Philip Brothers would do this all the time. But that's an example. Does anyone have any questions of what I just said? Because I know I use a lot of terms of art there. And hopefully it was, I can talk about that for hours, but that's just one of a million examples. Does anybody have any questions or color or wants color on that? Because I got killed by fibro a lot of times. Thanks, John.
Great story.
Hold on.
Great story.
Well, that's one of them. We haven't even gotten into the guy who got stabbed with a pencil.
Somehow I knew once you that guy, the futures were going to be a little more difficult to buy this time around.
Yeah, and that exactly. So I didn't front run him next time, and of course next time they ran me in the other way. But the reality of it is sometimes they would if there wasn't a refinery fire, they would let their broker leak that there might be a refinery fire. So I mean that's the kind of stuff they used to do. But it was okay. I didn't complain about it because it was professional on professional. I don't like it when it's done to retail people. But so that's the idea, basically. Sometimes we don't have to go back too far on this. And I want you to, if you look back at when Andy Hall was trading this, Andy Hall was doing this, okay? But when you look back not too long ago when Andy Hall was super bullish on oil and he got stopped out. Now, this is what I laughed because I knew it was going to happen. When he started getting hosed a couple years ago and he had to puke, it was leaked to the market that he was buying calls hard and a lot of them. And this is like years after the floors closed. And I'm like, he's buying calls and he's long oil and oil's down. Looks like he's doubling down, people would say to me. And I'm like, no, he's buying those calls so people go in like me, buy futures to stabilize the market. And every call he's buying, he's probably selling 2 futures against it. He was creating bids so he could create liquidity to get out. So he bought those calls and converted them into puts as he was selling. And he did that 2 years ago when he got out. So that's pretty much it. It happens all the time. People buying calls are not necessarily bullish. They could be, they want you to think they're bullish so they can get out of their longs.
He was a bear dressed in bull's clothing.
Exactly.
All right, so let's wrap it up here, guys. We got, Delta is the most, Delta, Gamma, Theta.
Right. And I'm going to add another definition of delta for everyone here so you can really scratch your heads. There are 3 definitions of delta, not always the same. One, as we said before, is correlation with the underlying. So if something has a 50 delta, if Apple rallies $1, you expect that share. We're ignoring gamma. We're ignoring all other Greeks. You would expect that the stock, that if the stock rallies $1, a 50 delta option will increase in value. A 50 delta call will increase in value by 50 cents. That's a correlation with the underlying. The second thing is, which is the one that most people know, is if it has a 50 delta, it has a 50% chance or 50% probability that it will expire in the money, okay, at expiration. That's a second definition. The third definition is hedge ratio. So the hedge ratio is if you want to be delta flat or have no directional opinion, you would think you would, if I bought one of those calls, I would sell, well, I'm going to use round numbers, not stock options. If I bought 100 calls, which got me along 100 deltas, I would sell, and they were 50, I'm sorry, if I bought 100 calls that had a 50 delta, I would be along 50 deltas, and I would sell 50 futures or 50 shares of stock to be flat directionally and agnostic directionally and have no opinion. You would think, forgetting the probability aspect, that when I say the correlation movement with the underlying is the same definition as your hedge ratio. It is not, because of other esoteric things. So I could buy an option with a 50 delta and then sell 50 shares. And when the market rallies in stocks, it doesn't perform with a 50 delta. It performs with a 48 delta. So the hedge ratio is 50, but the correlation is 48. Now, why would it be less than 50? That's because of another Greek, and that Greek is Vega or Vol. And that's because as the market rallies, and if you look at the, Tom, can you put up your Apple smile?
Yeah, sure.
We're not going to get into this, but I want to touch on this. The third definition of delta is the definitions are probability expires in the money. We don't care about the definition right now. Two definitions we're looking at are correlation movement with the underlying. And the other definition is hedge ratio. Okay, those two things you would think are the same thing, but they're not necessarily the same thing. An option that has a 50 delta for hedge ratio, you would think that means it has a 50 delta correlation with the underlying. But those two things diverge. And you can tell when those two things will diverge when you look at a volatility smile. A normal volatility smile, you would think looks like a U, where the at the money is the lowest volatility because it actually is the highest premium. And as you go further out on both sides equidistant, and a perfect smile, which is why they call it a smile, but equidistant calls and puts have the same value. But when you see a smile that Tom has up there right now for Apple, which basically says the puts go up in value and the calls go down in value, that means the out of the money options, you're looking at something that says to you that the deltas that your sheet are giving you or that your model are giving you are probably wrong. And that's because in the stock market, a 50 delta option for hedge ratio, the market rallies $1, it may only go up 48 cents. It may only go up 47 cents. And that's because volatility will come in. And if volatility comes in, that changes your delta. That's why there are three definitions of delta that aren't always all the same. Correlation, movement with the underlying, hedge ratio, and the one that is always true is percentage probability of expiring in the money. Not just touching the money, but expiring the money. I hope that that was enlightening for you guys, because that will bridge us into the next level, which is discussing volatility in our next class, hopefully.
Yeah, that's a great point, Vin. Because I mean, just to piggyback on what Vince was saying, you look here. This is a picture of volatility skew for Apple options that expired December 21.
It's a volatility smile with a put skew. Does everybody understand that?
Yeah. So most equity options or index options are shaped this way. The vol curve is shaped this way, where they're sloped. They slope hard from upper left to bottom right. Because I mean, the risk the risk is on the downside. The accident is on the downside in stocks. Okay, so that's why tails are always bid up in equities. Usually, it's atypical for Apple, but typically in equities, the tail, the puts, baby puts, are always trading higher volatility than
right. And in simple supply demand concept, sorry to break in, but in simple supply demand, if the out of the money puts are trading at a higher level than the equidistant out of money calls on the other side, that's because, Gabe, to your answer, that's because in a very simple way, before we get into the Greeks and complexity of it, it's supply and demand. That means more people want to buy puts than want to buy calls. Or in this case, more people buy puts and more people sell calls. So you have a put skew in a stock, generally speaking, and XDM, is there always a put skew in stocks, just Apple? There's not always a put skew in stocks, but there's generally a put skew in anything where the dominant player in the market is a producer, and I'll get to that in a second. The reason puts trade at, generally, not always, but the reason puts trade at a higher volatility level, equidistant to their call counterpart on the other side, is because people buy stock generally. And if you buy a stock and you're a hedge fund manager, you need to protect yourself. So you'll generally do what, and you've heard this term from Tom before, you'll do what's called a collar or risk reversal, or in commodities, they call it a fence. You will say, I need to buy insurance, so if the market goes down, I don't get hurt too much. So you'll buy a put, which drives the price of puts up because there's so much demand. And then you'll say, I don't want to spend all that money on that put, so I'm going to sell a call. So buying puts and selling calls is common in a market where the most dominant player is a long player. The most dominant player in options is a long player in the stock. And so what you'll see is a put slope or a put skew in stocks most of the time. Is it fair to say you should always be short the fences, long, short put, long call? There's two ways to look at that, and Tom's typing an answer. Yeah, it's the answer is the first answer is no. The other answer is in the concept of a fence or a risk reversal. If you have no exposure in the underlying, you're just putting on buying call and selling put. If you intend for regression to the mean, and you don't think that the market's going to go up or down more than either of the strikes you're trading. So we're looking at Apple, right? And Apple's trading, let's say 180. All right. You look at the 160 put, and that's trading at a higher price than the 200 call. And if you were to just sell the 160 put and buy the 200 call, and not do anything, and you're saying I don't think the market's going to go below 160, and I don't really care if it goes above 180. What you're saying is you think that the skew, the slope of the smile is unjustified in the long term. Everything goes flat, black shoals, but the demand makes the increase in the put versus the call there for a while. In other words, just because a put's trading at a higher volatility than the equidistant out of the money call does not mean that the probability of the put going in the money is higher. It just means there's more demand. So if you're a person who plays regression to the mean in skew, you sell the put, you buy the call, okay, and you sell futures or stock, and you say, I don't care because I think both options are going out worthless or the skew is unjustified. If you're a person who likes to surf the skew, you buy the put and you sell the call, and you buy futures, you're delta flat. And when the market goes down, you make money on what's called change in vol. So it depends on how you trade, and it also depends on the market itself. Being short put, long call, gold is a good example of that. We're not going to do that today, but a good example of a skew, a market that was a call skew, getting annihilated and becoming a put skew is the gold market when GLD was listed. We could talk about that at another time. With an underlying position, yeah. My answer to that is XDM. If you have an underlying position and you're buying put and selling call, and your underlying position is counter that, meaning you're long stock, you're paying for insurance. You have to do that because you're worried about the underlying position. But the person who's doing it the other way is saying the skew is unjustified. I'm not worried about it. I don't know that we have enough time to go into this developer. If I was bullish to 220 and Apple, what should I do? Tom, you should take that. With this vol profile, if he was bullish to 220 and Apple, what type of structure would you suggest?
Yeah, I am very bullish in Apple as well.
Are you talking about a naked? Hold on, I'm gonna help filter this for you. XDM, are you talking about a naked option structure, something simple, or do you want something more esoteric? Like, do you care about volatility, or are you just looking at a directional play as well? He's typing now.
Right here.
Getting off in 2 minutes, so I want to get. This is a good question. I want to answer it. If I was bullish 220 Apple, what should I do? Well, I'll tell you what I would do, which is not what you're going to do. I think if you're unless you're trading professionally. Something point of discussion. Okay, so Tom, so he's bullish to 220. Okay, yeah. He wants what if he's bullish to 220? If you're bullish, Tom, to 220, not him. If you're bullish to 220, how would you express that bullishness using? We're going to use these options. I want to use the 180 put and a 220 call. Would you sell the put and buy the call, or would you buy the put and sell the call and buy stock? And you can do both, but what's the reason for doing them differently?
If I was bullish, I would. I'm going to be long stock, long and out of the money put, and short an upside call. But I think the more attractive way to play Apple right now, with volatility as inflated as it is, I mean, it's trading 30 vol out 30 days. It's typically about a 21 vol instrument, and the skew on these upside calls, like 20 delta stuff. Where do you have my screen? Hold on. Yeah, the 20 delta stuff, and I can show it to you in a sec. Here it is. this is 38 deltas. I mean, like the 25 delta, these things are hanging around 31 volatility. These are February 15, as you can see. Feb 15 options, 200 line. Hey, the first thing I'd look at, XDM, I'm with you. I kind of like the stock. I think there's just too much bear. Regardless of what I think of the stock. I think what you should be doing here, and what I have been doing, I've been losing nominal amounts, nickels and dimes. I've been buying 1x2s, ratios. I got a few out next week that are way out of the money, but now I got some out December 21 expiration. I have this on. I bought.
No, but he wants us to use a collar. So,
oh yeah, the collar.
To our point, an example to our point. I just want to throw this out there. The market's trading 180. What is it trading 180? 180.
Yeah, 170.
And XDM is bullish at 220. And I'm going to say to XDM, do you mind selling stock at 220? And he's going to say yes. I'm going to assume he's going to say yes because he thinks it's going to 220. Great. Okay. So buy stock now, sell the 220 call, and buy the 180 put. I'm sorry, buy the 160 put. So you would end up laying out money for your position, but you'll be bullish at 220 with a stop out if you're lower. Depending on your risk, you'd pick the put. Maybe it's the 170 put, maybe it's 160 put, maybe it's 150 put, but you be long stock and you'd sell the 220 call against it. That's a covered call, right? People do that all the time.
Yeah, I mean, you could also do it. I mean, you could do it just a straight 10 up, 10 down collar, right? Good 10% down is like 161 roughly. Say a $4 put, and sell the 200 call. Cost you 370. You pay 30 cents and buy the stock. You're in for 179 spot 83. You got and you just stopped out at 160. You stopped out at 160, and you participate up to 200. Now there's no look. I mean, as you and I and Mike have spoken about ad nauseum, you don't get called away unless you let it get called away. So the notion of, oh my God, I'm going to lose my stock at 200, that's amateur hour. That doesn't happen. If you don't want to get this stock rips. That's like a moron. If this stock trades 195 next week and you're working 200 calls, buy them back, sell the 210s, buy the 160, sell the 160 puts that roll to the 170. You constantly roll. These strategies are fluid, and you can just and they're obviously very, very liquid and scalable. So to start with, if you like the stock here, I buy stock like Vince. I like a 10% collar. Buy the 160 put Feb. You get an earnings period in there. Sell the Feb 200s. All right, sell the Feb 200 calls. That costs you about, you could probably pay 410 against 375, 35 cents plus 179.40, 179.75, all in. Stopped out at 160. Okay, you're going to participate up to 200. Okay, stock runs to 190 in the next week, which you could. I don't know. You can roll up, which is what I would do. I'd advise doing it. But I think as an initial position, that's the way to do it. You're getting paid. Look, everything's rich in this thing right now. I don't want to be. I'm not really an advocate of being long Vega in this stock right here, right now, because you're paying up. You're paying premium prices. Now, you want to do that thing, and you really feel convicted that the stock's. You really feel convicted that the stock's heading higher. That's cool. Then you'll be okay. But I would advocate some type of ratios. I like any of these ratios where I could buy one, sell. Buy one, sell two to 190, 205. Something like that. Go a little bit close. I go into January or something like that. But 190, 200 costs you about 80 cents 1x2. You could tighten up the ratio. Look, what's going to happen is if this stock rallies, if it trades if it goes back to that old gap low 190, that 190 level from org 1, what do you think is going to happen to volatility? You think it's going to be 30, or do you think it's going to be 24? You got to realize. I think what you've had here is and I think Vince would concur. You've had a massive puke. A stock doesn't go from 233 to 171, 62. What's that about? That's about 26 and a half, 27%.
Agreed. But you're getting it. You're getting into charting.
No. What I'm saying, it's a puke. You had a massive dislocation in this thing. You had a puke. The time for puts was 4 weeks ago. The time for puts is right now.
Right. On a relative value basis. We got to actually, Mike just let me know we got to wrap. But yeah, on a relative value basis, I don't want to buy puts right now. But the two things that XDM I think can walk away with are if he's bullish to 220 at the very simple level, and he wants to buy stock, you buy stock, you sell a 220 call, and then you buy the put that you think would is the level that you're least comfortable being long under. Anything else? You have to talk to Tom about because we're talking about relative value in terms of vol This is how much you wrap in terms of
Yeah,
how
I
much
mean,
you spend.
Vin, I think X is probably better served. I mean, yeah, look, we can agree to disagree. That's not a problem.
Yeah.
I think you want to buy. Do that simple freaking collar, the 160 put, like you advocated. Sell the 200 call. This is it. I'm looking at Jan, but it's in Feb. Do that
Yeah.
thing. It's a nominal freaking debit. You're long the stock. Let her. If the stock, if you're right, I have no reason to believe you're not. We can roll up, and you got to roll. You got to freaking roll. Nothing wrong with that. The Rolling Stones have been around for 50 years.
We're going to continue. Yeah, exactly. We're going to continue this tomorrow, actually, because there's definitely different ways to talk about it, and I think that's a good way to move into volatility by discussing relative value options as you're expressing bullish positions and hedging yourself. But we do have to wrap right now. XDM,
If I didn't
whatever
cut
your
you guys
question is,
off, if I didn't cut you guys off, you'd go until 5 p.m.
At least.
You got
go right
to
I go
pace
right
yourself.
you know what, and that's fine.
You got to
That's
pace
actually
yourself a little
humorous.
each day, a little each day. You guys can get a taste. That's providing amazing information. Both guys have over 30 years experience. Tom McEntee, Vince Lanci. Thanks a lot. We'll talk to you guys tomorrow. And they're available in the chat room to continue the conversation for the members.
Thank you so much, Michael. Have a great weekend. All right. We'll talk Monday. Take it easy, brother.